But heading into next week, we're getting into anticipation. At the moment, volatility is extremely low. Okay, the VIX volatility index dropping to low since April, 3 months, and volatility index, the complacency measure that I talk about so frequently, is at its lowest level since way back here. I believe it's October in 2019. Not good. Volatility, however, from a historical basis, heading into the 30th week of the year, finally turns that corner. All right, I misread when I did the video last weekend, but we are finally turning the corner of activity. It really picks up in the first week of August, but for now, it is historically expected to turn the corner. Now, this actually aligns to the scheduled event risk, and it is dense. All right, we are going to run through some very serious event risk through this week. What kind of event risk are we going to be getting into? Well, there's a lot. There's a lot here. I will break it down into two themes. So the number one theme that I'm going to be watching, because it has the most representation, and I think it's the end game when it comes to fundamentals, is growth expectations. Well, recession fears is really what it boils down to, because it has a negative view in the bias of the markets. And we left off this past week with an update to the timely PMIs for the major developed world economies for the month of July. And the outcome was not good. You did have some better than expected outcomes from a couple of them, but it was nevertheless a decline from the previous month universally. And two major economies, the US and the Eurozone, went into contraction. Contraction is anything below 50. Very particular, the US, the largest economy in the world, reported that its service sector, the largest sector by far, over more than 3/4 of output and 3/4 of jobs and services, turned into contraction for July. That is not an encouraging sign. And you did register very clearly from the 10-year yield, which took a nasty spill, and it exacerbated the 10-year, 2-year yield spread, the recession warning that people often reference, and we have referenced to pretty consistently here. So we are left with these very disappointing expectations. The mood has definitely shifted lower. And that kind of mood is how we need to take in event risk. The Fed alone carries an inordinate amount of weight. All right. The question that we have here is, will they go 50 or will they go 75? And there's definitely ways to not just measure this expectation, the Fed funds futures contracts, or here in the CME Fed Watch, you can see it's about an 80-20 split. At its peak, it was the opposite. So there was at one point a 20% expectation of 75, and 100 basis point rate hike was at 80%. But obviously, that has throttled back significantly with Fed officials really trying to talk that down. I do think that sets expectations, that resets our assumptions and how markets are going to respond, but don't assume that just because this is how the skew sets up, that it's naturally going to be to reset the market's response.